to bring in now BNY Wealth's Chief Investment Officer, Sinead Colton Grunt. Okay, Sinead, so you wrote that the global growth, U.S. is the anchor for it. We're going to bring up a table and just sort of pinpoint some of the reasons that you're suggesting that and talking about. Before we do that, though, let me ask you about this, because the rest of the world, they are, we'll bring that chart back. They're doing some things, right? I like what they're trying to do in Europe. I don't know if it's too little or too late, to be quite frank with you. I love the election victories and the policies they're doing in Latin America. So some of that stuff is tradable right now.
It is. And look, I think from your opening comments, one of the things that we've always thought about is that it's American leadership, and we think that's still intact. Now, other markets, other economies, they're coming from a much lower base. Let's not forget the 20% plus returns that we saw in the US.
Right.
Global growth is going to be just above 3% this year. That's pretty strong. But the US economy is still, we believe, going to have the highest growth of all developed markets.
Yeah, and IMF, by the way, agrees with you, right? So and with that in mind, we've got spending, we've got CapEx, we've got productivity. I don't think anyone is even, you can't really dispute any of this.
That's right. I mean, look, the consumer drives over 2/3 of the U.S. economy. We know that it is being driven by higher income consumers. However, they continue to spend even though confidence levels are a little bit lower. And notwithstanding all of that, as tax refund season starts to get going, we're going to see another, call it, 160 billion coming into the economy from tax refunds.
But before we move on to what's happening right now in today's market, the flip side of that, though, is inflation. And you do say you're still a little anxious about inflation, or at least the levels of inflation.
Yes, we are. And so for the end of the year, we expect that inflation is going to be, the midpoint of our forecast is around 3%. A large part of that is because shelter inflation tends to be stickier. It's about 40% of the measure. It just moves a lot more slowly. And we do have some concerns around the additional level of consumer spending that comes through from those tax refunds.
Right.
But 3% is not a bad level.
No, listen, I'm okay with it. I think the new Fed might be okay with it too, a new Fed chair. All right, today's session, SanDisk is exploding again, Micron's exploding, Seagate's exploding, and really it was news from a Japanese NAND flash maker, right? Up 12%. This story doesn't go away. In fact, you say it's still early innings for this memory part.
That's right. And so that's one of the things that we think is most exciting when you have days like the last few where you're seeing a sell-off across the board in tech stocks, because they're not all created equal. The benefits that AI will bring, you can put productivity gains to one side, but memory is going to be so important because that is really the key bottleneck. And at the moment, there is much less memory available than there is demand for. You've got a really tight market. That's why you've seen prices increasing.
You'll have pricing power well into next year, right? I mean,
that's right. And so the memory super cycle, which is how we're thinking about it, you know, it potentially continues not just through the end of this year, but also potentially extends out as far as 2028. So that's a huge opportunity.
The market itself, you know, sort of, we always say earnings are the mother's milk of markets. So you look at earnings, net share of earnings for the S&P and the market cap, and they're just about the same. Okay, tech, 26%, 33% of market cap. There's some adjustments, but do you think this whole thing should be flipped upside down? Essentially, you know, we're staples and some of these other smaller indices. Are you concerned that maybe they could be overbought right now, because they are safe havens, but they're expensive safe havens right now?
Well, look, we do think that having a more diversified approach makes sense. There are sectors we like tech, financials, industrials that are more cyclical. But what really encourages us is that we're seeing a broadening of the gainers in markets. It's no longer just a tech story. And as we look out to the end of this year, we expect the S&P will be at 7,500, but most of that is coming from earnings expansion or earnings growth rather than multiple expansion. Again, the sign of a very healthy market.
Right, I agree with you, but I think we'll get a little extra multiple expansion there too. Great.